The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
It's Nvidia's world. We're just all living in it. From Studio 2 here at Bloomberg headquarters in New York, I'm Raymond.
And I'm Scarlett Fu. Alex Steele is off for the day. We're kicking you off to the closing bell here in the U.S. And right now, we're looking at stocks being broadly lower. At one point, it was on course for its worst day since August 5th. So that just gives you a sense of the negative prints that we're seeing here. If we drill down, you can see the Magnificent Seven underperforming with all 7 names in decline. Now, drilling down even further, you look at Nvidia down by 1.9%. We've got about 80 minutes or so before Nvidia's earnings release. A release that will be as picked over as any jobs report or FOMC statement. Treasury is falling at the long end of the curve with the yield inching higher on the 10-year to 3.83%, Romain.
All right, but let's get back to the elephant in the room. And of course, that is Nvidia, the big macro event that isn't macro at all. It's been 5 quarters now where Nvidia has posted triple-digit revenue growth. And that is a streak that likely continued for a 6th quarter based on analyst expectations for that earnings report tonight. That's the effect of being the main beneficiary of billions of dollars in AI spending. But that spending, as we know, has slowed a bit, and that has the market a bit on edge, kvetching about what is easily the most phenomenal stock of the past couple of years. And not just phenomenal, but the most consequential to boot, accounting for 6.7% of the S&P weighting, 11% of the NASDAQ, 14% of the Philadelphia Semiconductor Index. And those weightings mean not only does the company move U.S. stocks, but the importance of AI and chip proxies in Korea, in Taiwan, in Europe means Nvidia will influence trading across the world, too.
There's no question Nvidia is a large part of market movements because of the representation it is in most indices and most people's portfolios, if they're indexed, that is. But I think the market's moving away from that. It's broadening out. There are
Now, for better or worse, Nvidia will indeed dominate the market chatter today and probably into tomorrow, but it's not the only story in town. One of its main distributors, Supermicro, which had rode that AI wave to stardom, plunging almost 30% today after delaying its 10K filing in the wake of that Hindenburg report. And then you have Salesforce, one of the biggest corporate tech spenders out there. They report after the bell, as does NetApp, Okta, Applied Digital, HPQ, and CrowdStrike, Scarlett, each with their own potential to move the market.
Absolutely. But the story of the day of this year, really since the end of 2022, is Nvidia and its influence on the equity bull market. Bloomberg's Ed Harrison featured this chart in his latest Everything Risk column. And what it shows is the S&P 500 in orange taking off after the Fed's last rate hike in July of 2023. You've got this meltdown this summer, and there's that big dip. But that was brief, and Nvidia in white and large caps have pretty much recovered. Ed Harrison says we really need to see new record highs achieved for the rally to be confirmed. The rub, of course, being that anything negative about future growth from Nvidia will have market-wide implications, especially after earnings from the other Mag 7 names raised concern all that AI spending has yet to pay off.
All right, the company expected to report almost $29 billion in revenue in the most recent quarter, double what it did in the year-ago quarter. Dan Morgan joining us right now, Senior Portfolio Manager over at Synovus Trust, which has about $19 billion in assets under management. And I want to start off with that revenue growth story because that has been basically the stock price appreciation story. Even with the slowdown in that growth, Dan, from basically 200+% to now 100% here, does that still leave you, I guess, positive on the longer-term outlook for this company?
Well, Romain and Scarlett, I would expect that revenue growth rate to start to fall, actually, going into subsequent quarters, just because the comparisons become so difficult, right? But as you mentioned, Romain, coming into this quarter, consensus at 28.5 billion. Most likely they're going to have to do a couple billion over that and guide into this upcoming 3rd quarter above the consensus, which is about 31.5 billion, I think, to really move the stock in the interim. So. But I would expect, Romain, that the year-over-year growth is going to continue to slow down just because it's harder to keep topping these huge comparisons.
I am curious, though, too, about this slowdown that we've seen in some corporate AI spending. And there's been a lot of talk made when we talk about the Mag 7 and how concentrated this market is. But there's a lot of talk about how concentrated revenue sources are for Nvidia. More than 50% of its revenue coming basically from 5 companies like Microsoft, like Meta, like Supermicro, and Alphabet here. Does that concentration give you any concern?
Well, I mean, if we talked earlier about some of those conference calls, and you look at the guidance that all those guys gave, the FANG stocks, so to speak, the Metas, the Microsofts, they were all anywhere between $40 and $50 billion in capex that they were going to spend, and a large portion of that's going to go to data center AI. So when I heard those numbers, I was actually very encouraged by them. Also in the fact that AWS, GCP, and Azure all showed an acceleration in year-over-year growth in the second quarter, which was due to data center and AI. So, but you're right, it's a very narrow group, right? If those guys start to peel back, Scarlett and Romain, they do have other areas that they're in, but it's so heavily intensive with these, data center spend rates.
Yeah, data center is really the driving force of, at least of the stock. You mentioned that the data center segment now generates more revenue than both Intel and AMD's combined data center units. One thing I find interesting, Dan, is that you bought into Nvidia back in 2018 before people even talked about AI in data centers. What was it at the time that attracted you to the stock and that still retains value even if the spending on AI chips starts to slow down more than we might expect?
What's interesting, Scarlett, is the reason that we added that to our buy list back, 5 years ago was really just based on the fact that in the past we had always perceived them as really just a gaming stock where they were producing GPU chips that were used in the gaming space. And they started to come out with chips that were going into the data centers and competing directly against AMD and Intel, and they were gaining market share. And all of a sudden it flipped where the amount of revenue they were generating from data center actually exceeded their gaming segment. And that was quite a few years ago. And kind of in the rear view mirror would always be like, oh yeah, by the way, we have 70% share in the AI chip space. Nobody really cared. They would talk more about the omniverse. If you remember Meta, Facebook changing the name to Meta and talking about the omniverse, they had a lot of chips that were skewed towards that they would talk about. But that's why we put it on the buy list. And, it's just, it's kind of like putting Apple on the buy list back in 2005 with the iPod, and then all of a sudden the iPhone came out and exploded. So just, hit a nice home run. What can we say? Clients are happy.
A massive home run, and I'm sure that it comes up all the time when clients speak with you. One thing about these results, we've seen this with, say, Abercrombie & Fitch. It had a beat and raise quarter, but that wasn't enough, and the stock is falling today. Nvidia could have a beat and raise quarter, but it seems like the whisper number is back. It needs to do more than just beat, doesn't it?
Scarlett, that's the challenge coming in this report. You mentioned, Romain said, over 100% growth on top line for this upcoming second quarter. But everybody's hanging their hat on the Q3 number, right? So if consensus is at 31.5 billion, I've heard whisper numbers as high as 33, 34 billion. So it's almost like even if they beat the estimates, but they don't hit that 33 or 34 billion mark in terms of guidance on the third quarter, it's almost like a disappointment, right? Even though they're growing over 100%. So it's a tough crowd to please right now.
Absolutely. All right, Dan, we'll see how it all shakes out in just about an hour and 10 minutes. Dan Morgan from Synovus Trust. And be sure to tune in to a special edition of Bloomberg Technology. We've got an interview with Nvidia CEO and co-founder Jensen Huang. That is tonight at 6:30 p.m. Eastern Time.
All right, coming up, we got a lot more to talk about, including what's going on in the ETF space. Inflows starting to heat up here. July, the second best month of flows for funds ever. A sit down with the CEO of one of the largest ETF providers in the U.S.
Plus, PE firms are getting ready to play ball with the NFL. After the league's historic vote yesterday to allow private equity ownership in teams, we sit down with the NFL's executive vice president and senior advisor, Joe Siclare.
And we keep a broader eye here on the market here. Nvidia going to have potentially a huge impact here on that broader market. Stocks on the back foot right now. That could change in about 50 minutes' time. Stick with us. This is The Close on Bloomberg.
Summer can typically be a sleepy time for trading, including ETFs, but this year the funds are seeing a surge. You look at July, $122 billion of flows made it the second best month on record. Now, every month so far this year has exceeded the historical 10-year average, which you can see on this chart. The bars representing the long-term average, the 2024 lines indicating where we are this year. Van Eck has more than 60 electronically traded funds under its management, including a new one it announced today that began trading following the big sector behind today's big story, and that would be semis. CEO Jan van Eck joins us now. So, Jan, the ETF we're talking about here is SMHX, which kind of plays off of your existing semiconductor ETF, SMH. But there's a distinction here. Walk us through what SMHX does.
Sure. For the whole ecosystem in semiconductors, it's really broken into this bifurcation between the giants that make the chips, like SMC, and the designers, and then the equipment makers. And if you like an asset-light model, like a lot of people do, and you want to avoid the risk of manufacturing chips, which has tripped up Intel and other companies, then you can actually put together a portfolio of these fabless semiconductor chips, so SMHX.
Is there any overlap at all between SMH and SMHX?
Yeah, a bunch, but not exclusively. So you take out the fab companies, like TSMC is a top holding of SMH, and you take out the equipment manufacturers as well. So it trades differently. Probably not surprisingly, it's outperformed actually over the last 10 years or so.
Can I just follow up with that? Does Nvidia fall in that category of SMHX because it does?
Oh, yes, for sure.
Okay,
it's
because it does
darling.
rely on TSMC too. So.
Right. Nvidia has been the star of SMH as well, but what you're excluding is the fab manufacturers and the equipment makers.
Got it.
And so you're just getting those like 20 or so chip designers that don't require as much capital and have performed really well. And a little bit of the bet, we think, is that in 2 or 3 years, Nvidia, God forbid, will have competitors. Mm-hmm. And amongst the competitors will be those companies, the other companies in the fund.
Well, what about for the sort of further along that sort of supply and purchase chain? There's been so much focus on the chips themselves and to, I guess, a secondary extent to the hyperscalers and the data centers here. But what are investors really looking for? I know for right now, everybody wants Nvidia. They want basically the person or the company that's making the chips. But at some point, they're going to evolve too to try to look for other beneficiaries. Are we seeing that baked into the ETFs just yet?
Well, I mean, I think Nvidia is trying to lock in its market share, right? I mean, it's got like 70% market share. It owns the AI, and it sees the competition coming. So through its CUDA software, right, they're trying to lock in that hardware dominance. But the other software companies, I mean, you listen to them. It'll take them 2 or 3 years, but they're coming. And they, with a high degree of confidence, feel the same demand from customers for diversification for their data centers.
When do you get to a point where you feel like it's worth coming up with a new product to address that? Like, what's the critical mass that you look for that it makes it worth your while, it makes it worth Van Eck's while?
We want to have a simple, clear, pure play. That's what we look. And we've been looking at this, trust me, with SMH being 20 billion, we've looked for a lot of different ideas, and this is the only one that finally came across our radar screens.
This is another ETF in a long line of thematic ETFs that Van Eck has. Thematic ETFs were once the thing, but they've kind of given way to income ETFs and buffer ETFs. How do you see thematic ETFs fitting into someone's portfolio?
I mean, it's sort of a core satellite concept, right? You want to have the vast bulk of your retirement savings, your non-play money, in 60-40 portfolio, right? And then it's what do you want to overweight? And I mean, semiconductors has gone from like 2% to 10% of the S&P. So I guess it's kind of beyond thematic since it's so much it's bigger than the energy and finance sectors at this point. But like one of the thematic plays I like, just to pick one, is India. So just in 10 years, you just know that country is going to be about the size of all of continental Europe in terms of GDP. And the stock returns actually over the last 5 years have matched that of the S&P. So I just say, I want that in my portfolio. I'll call that thematic, even though it's a country, if I have high conviction over the trend.
How much diversification, though, is necessary in these types of funds to take advantage of those themes? I think back to when we started to see a lot of ETFs in the EV space. But it was just dominated by Tesla. And if Tesla had a bad day, then the ETF had a bad day and vice versa. How much does diversification matter? Do you need that?
I think you do. I think that's a great question. That's something when we talk about pure play that we look for. But you also, to your point, want a certain maturity to the businesses, right? If they're not even making EVs, right? But they came public through a SPAC or something like that, that's a little scary. So the good thing about the semi space, it's been around for decades. I mean, TSMC went in public in 1993. So even this idea of fabless has been around for a long time.
All right, Jan, great stuff, and really appreciate you taking time for us here on a very consequential day for the broader markets. A closer look here at the ETF world. Jan van Eck, Chief Executive Officer at Van Eck Associates. Coming up here on the big program, we're going to take a closer look at what's been going on in the bond market. This is still a big week for macro with some consequential data coming at the end of the week. Karissa McDonough, fixed income strategist at Community Bank Trust Services. She'll be joining the big program in just a second. This is The Close on Bloomberg. All right, let's get a view from the sell side. Time for our top calls. The big movers on the back of analyst recommendations, and we start off today with United Therapeutics. Oppenheimer raising its price target to a street high $575, up from $400, with the analyst positive about the drug maker's prospects to treat patients with the lung disease known as IPF. The treatment, the analyst says, could add $5 billion in peak sales over the next few years. The shares moving higher here, up about 3% to a record high. Next up, Moderna, an upgrade to hold from reduce over at HSBC. The price target staying where it is, with the analysts seeing great potential for Moderna's mRNA cancer vaccine as a future revenue stream. Moderna's vaccine, which is entering late clinical stage trials, is leading competitors in the race to get a vaccine to market. Nevertheless, the shares moving slightly lower on the day. And finally, we have to talk about Supermicro Computer. Losing its buy rating over at CFRA, the analyst saying he's concerned that the server equipment maker delayed filing its 10K annual report to the SEC. This a day after allegations from short seller Hindenburg Research about Supermicro's accounting practices. While CFRA is still positive about the long-term fundamentals, the analyst says probably best to exercise caution for now. The shares, which were down as much as 30%, pairing some of those losses, now down about 19%, and those are some of our top calls.
All right, SMCI, the worst performer in the NASDAQ 100 today with its 19% drop, Raymond, that you mentioned, more than double the second biggest decliner. Let's turn now to market action in treasuries on the heels of today's 5-year auction, which saw the lowest results since April 2023. You can see right now the 5-year at 3.66%, the 2-year seeing some buying there, pushing the yield lower at 3.86%. The 2-year, of course, ultra sensitive to Fed policy. I want to bring in now Karissa McDonough. She is fixed income strategist at Community Bank Trust Services. Karissa, it is good to speak with you. I know that everyone's fixated on equities, in particular one big cap growth name in equities, but there is a lot of economic data coming up at the end of the week, notably core PCE, which people will really gravitate around. How are you thinking about expectations heading into this data point, given the pricing of Fed cuts, expected Fed cuts?
Great. Thanks so much for having me. We are believing that inflation is actually becoming under control. I think the survey data that we've seen earlier is not necessarily matching with kind of historical hard data. And I think kind of each inflation data print that we've seen coming out, and PCE is no exception. We would expect that to stay with this whole notion of the Fed has been, very careful in leaving rates where they are, and we think that that will follow suit and show that inflation is coming under control.
When you look at what the market is pricing in right now, 4 rate cuts through the end of the year, 2 full percentage points of cuts in 2025, how comfortable are you with that pricing?
If you had asked me that question before Powell's speech last Friday, I would have said, very measured pace, like this Fed has been very careful, like I said, with all the data points. It's very deliberate. But, when we heard Powell himself come out and say, well, it's time to start cutting, not necessarily believing that we're going to have possibly 2 in September, but I don't think that that's off the table. I mean, let's not forget that, we had the minutes come out from the July meeting, and there were members of the Fed that believed that cuts were appropriate at that meeting. So if Powell is now on board, I don't think, 1% by the end of the year, 2 percentage points. Actually, we're seeing closer to over 2 percentage points through early 2026. I don't think any of that is off the table. The Fed has a lot of history to base their decision making on. And I would say that this is one of the more successful Fed policy cycles that we've had, but we are at a transition point.
Yeah, certainly so in hindsight, and you look back on it and all the criticism that they got for the delayed start to this cycle here. Now they kind of find themselves in that same position again. I am wondering, though, as an investor, Karissa, I mean, if you buy into this idea that rates are coming down, we can debate by how much and how fast, but if they are coming down here, are you comfortable now extending duration, not just in the Treasury space, but also on corporate bonds, and for that matter, even something like mortgage bonds as well?
Oh, excellent question. Duration is absolutely our top trade at this point, and we've already had a significant move in longer rates. They've come down by close to 0.5%. But if we look at long-term 2s, 10s spreads, and we're finally getting back to maybe a not inverted yield curve, where we might see some positive yield curve action here. If that long-term historical average is something like 50 basis points or higher, then that suggests that long-term treasuries still have room for rates to continue to drop. So yes, long treasuries, top trade. We really like mortgage backs here. Yeah. That kind of, clarifies that duration bet too. So, well, yes.
Well, I am curious about the balance, and I don't want to get too wonky here, but you have a 2-year right now, basically at 3.9. You have a 10-year that's basically about the same, slightly less here. What if we run into the situation where we do see a meaningful drop in short-term rates as the Fed starts to cut, so that 2-year drops? But if we don't see that similar drop in the 10-year or even on the longer term on the 30-year here, does that sort of mess up that trade at all, or is there sort of a balance there?
No, you are still well positioned if you have that duration bet, and I would note that there's plenty of, you've got corporate exposure, you've got other kind of shorter term exposure. We're not suggesting that 100% of your portfolio is supposed to be in long treasuries, although we are kind of long versus the ag duration. We're around like over 6 years at this point, but you should have representation across the board. But no, even if you're just clipping a coupon in long treasuries and you have a little bit of a yield move down, that is still kind of a more magnified trade duration-wise than the benefit that you would get from a drop in 2-year rates. So that logic still holds.
All right, Karissa, great stuff. Karissa McDonough, fixed income strategist at Community Bank Trust Services. A closer look here at the health of the fixed income market. When we come back, we're going to take a closer look at the health of the private equity market. With fewer than 32%, with just 32% of PE firms launching so far this year, 32% fewer, I should say, than in 2023. We're going to take a closer look here at how the market is doing. Sunaina Sinha over at Raymond James will be joining the program in just a second. This is The Close on Bloomberg. Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu. And it's T minus, 40 minutes, 50 minutes before Nvidia's results?
Yeah, we get the closing bells in about 30 minutes. Of course, Nvidia coming after the bell tonight. And, we kind of forget there's like about, 20 other companies also reporting earnings, but nobody.
No, it doesn't matter.
Nobody cares about them, although they should. I mean, there's some consequential ones in there, like Salesforce, of course, which normally used to be the bellwether. And then you got these kind of second-tier software companies that might have an AI story, so maybe we'll mention it after the 4 p.m. hour. But, of course, all the oxygen in the room is going to be sucked out by Jensen Huang and Nvidia.
And then after that, what happens? Does everyone just kind of do this? They wait for PCE on Friday, and then the jobs report the following Friday, and we're kind of done?
Yeah, I don't know. But, I mean, this has been the hot story, and we should point out here, of course, as we come back, we have headlines crossing the Bloomberg terminal right now on the AI space. The money continues to flow there. A new report out right now by the Wall Street Journal, a new funding round for OpenAI. Of course, Microsoft also participating in this. We don't have any numbers here, but it really gets to the broader idea here that this right now is where the money is going and maybe where it might go for some time. We do, though, of course, want to talk about things other than just Nvidia and AI and focus a little bit on what's been going on in the private capital market, specifically private equity. This year, through last Friday, 848 private equity funds have launched. That sounds like a lot, but it's 32% down from where it was at the same time last year. Here to discuss the state of private capital, where that money is going, and, well, where it might not be going, is Sunaina Sinha Haldea, Global Head of Private Capital Advisory at Raymond James, and she joins us here in Studio 2 in New York. Great to see you here.
Thanks for having me.
I'm actually glad that headline crossed the wire. I mean, we didn't bring you on to talk about AI and Nvidia, but as I'm sure you know, this is where all the attention, and for a certain extent, a lot of the money has been flowing to. When you think about the state of private equity and the idea that so much of what it does has been thematic investing, sort of following where the puck is going, those sort of moonshots here, how much has AI either helped or hindered the state of the private equity industry?
Well, I think what AI has done is certainly give a hockey stick effect to a number of businesses who, if they develop AI products, it can be a great inflection point in valuation. Now, traditional private equity buyouts, as you both know, only tackles sort of profitable, steady-state businesses. It's the game of venture and growth capital to really fund those moonshots. So while AI has been a great story for the markets in general and is a great promised land for many businesses, the reality of what actually exists in the state of the art in many businesses who are making AI plays, that's a story that's yet to be told.
One of the big issues in the private equity space, that's really ailed it, has been, of course, the big rise that we saw in interest rates, which now may actually come down, but also the whole issue, too, that some of the returns that were promised in the most recent vintages, at least for right now, haven't panned out. Are we maybe at a point where that is going to start to pan out, that these issues will be resolved?
I think there's a whole slew of the market, most importantly the limited partners that fund private markets, that are waiting for a change in the interest rate cycle to drive an M&A boom and therefore drive a return of capital boom to them. It has been slower than anyone expected. Last year was one of the lowest years for return of capital in the last 15 years, and so far year to date is the second lowest. Just goes to show that limited partners, the endowments, foundations, pension plans that fund private markets are saying that unless you get me return on capital back, I'm not likely to re-up at the same level as I was in the past. Now, this will resolve over time, and the interest rate pivot will certainly help, but it's been a struggle over the last 18 months, no question.
I think about what Scott Kleiman, the co-president of Apollo, said not so long ago in June. He was saying that I'm here to tell you not everything is going to be okay. There are going to be fewer realization and lower returns on the horizon for much of the industry. How much of that have we already seen? How much of that is still to come?
I think in terms of the realization part, he's absolutely right. It's been a very tough 6 quarters or so. Now, private equity runs on a clock. It's a 4 to 5 year investment cycle followed by a 4 to 5 year harvest period or exit period. We've run up against the back end of that, and the industry is now facing companies that they've held on to for 6, 7, now 8 years. I think the big risk is that of an aged assets problem, but with that clock also comes an impetus that everybody has to do something and do something soon, otherwise they're going to run out of that time clock. And so we have this pressure building where that's that interest rate pivot plus the elections that everyone wants to get past before the private equity sponsors really come to market to sell their businesses. And I think that we're going into a tick-up. We've been seeing the tick-up for the last 2-3 quarters, but that inflection point will really happen after the Fed starts cutting rates.
Okay, after the Fed starts cutting rates, how soon after the Fed starts cutting rates?
Well, if the Fed starts cutting rates and we get past the election and the elections kind of settle in, they're priced into the markets in terms of valuations, you're looking at about a quarter to 2 quarters thereafter. It takes about a quarter to sell a business.
All right, Sunaina Sinha Haldea, thank you so much for joining us. Sunaina is Global Head of Private Capital Advisory over at Raymond James, normally in London, but she joined us in New York today. Now, speaking of private investing, coming up, a touchdown for PE firms seeking a stake in NFL franchises. Will break down the fallout from the historic NFL owners' vote. This is The Close on Bloomberg. The private investing and sports world are buzzing today following the NFL owners' landmark vote. Team owners voted 31-1 to allow PE firms to buy up to 10% stakes in their franchises.
Who was the one?
Someone in Ohio. It's a move expected to attract billions of dollars in fresh capital. We sat down with Joe Siclare. He is currently the NFL's executive vice president and senior advisor, also serving as its former CFO. Here's what Joe shared about what led up to that final decision.
The committee's been working hard on this for a year. Over the course of that, we have many committee meetings, and we also updated the full membership several times during the process. So everyone was pretty much up to speed as to the direction we were heading. But when our ownership policy, we view that as, one of the fundamental strengths of our business model. Our ownership policy, the way we share revenue amongst the clubs, our debt policy. These are all things for a boardroom, not a locker room, but these are really important to our business model. So when you're looking at making a change to one of those, we spend a lot of time. So the 90 minutes that we were in there yesterday, there was not a lot of deliberation, but it was really just methodically going through the process, reestablishing and reminding everyone what our goals were when we started, going through the process of the last year, the meetings we had. We had a lot of discussion in the marketplace with industry experts and PE fund managers. So it was really just going through all of that and then laying out what the policy is and really focusing the full membership on some of the specific elements of the policy that we felt was important. So that took time. There was a little bit of conversation on the floor. I wouldn't call it deliberation, but a little bit of conversation.
How did you arrive at the 10% limit?
Well, that actually goes to the point of being very deliberate and measured. One of the things that, as we looked at what the other sports leagues did, as you know, they're much higher. I think our owners just want to take one step at a time. This is a very new emerging asset class. I think we could all have thoughts about where the market will go and what the market dynamics are, but no one really knows for sure. We do think that the program will grow. More funds will look to invest in sports. I think many of them look at it as an indirect way of buying into the best media content there is. Mm-hmm. So I think more funds will be interested. And as far as the league goes, I think more owners will look at this over time and think about how it works for their franchise. So we wanted to start at a lower percentage and then go from there.
Obviously, anyone who invests in anything gets a say to a certain extent in what goes on in that business. It's obviously a much different structure when you're dealing, say, with individuals and families that are a little bit more contained. With the whole PE structure, obviously you're dealing with the PE firm itself, but obviously all of their limited partners that might be investing in that. How much say are some of those limited partners going to have, or are they going to have to funnel that through the general partner?
Yeah, it's a great question, and that is actually, there's been a lot of attention to that. People hear about private equity investment. What does that really mean? In our case, the controlling owner, per our league policies, pre-existing league policies, has full control over every aspect of the team. Limited partners really have no governance say at all. And in this case, it's the same thing. These are non-controlling limited partner shares, no governance rights, no say in how the team operates.
In terms of timeline, you have said that the NFL is eyeing the first sales to be announced at the December owners meeting. Do you anticipate there to be multiple sales announcements at that time?
Well, we didn't say there would be a sale. What we told the owners yesterday is that we would try our best, now that we put the policy in place, we would try our best, if anyone was interested, to accommodate a sale, to go through our normal approval process. So if any transactions are ready to be approved, we'll do our best to get them approved this year. Don't know if there will be any.
Okay. What's the process then for each investment? Does the league need to approve each separate transaction, including when the firms exit some or all of those stakes?
Yes. Our typical policies are any sale transaction has to be approved either by the membership or some of it under certain terms are delegated to the finance committee. But all of our approval processes would still apply exactly the way they do with individuals here.
Well, what is the financial health of the NFL right now?
Financial health is excellent. Mm-hmm. We are the largest league by many measures. Every team is profitable. We have a long-term media deals, long-term collective bargaining agreement. Financial health is excellent. Every team profitable, so every team in theory could stand on its own. You don't necessarily need the cohesiveness of the NFL as it provides it. Well, they're all profitable. I mean, it is part of the. When you say stand on their own, I'm not sure what you mean by that. They have to be part of the league. Speaking, they have to be part of the league to drive their business, but they're all profitable.
You know, I look at the other leagues, and you mentioned the NBA earlier. It's seen moving forward with expanding its teams after signing that big media rights deal. The NFL currently has 32 teams, which is like a magic number when it comes to your playoff format. Is there any consideration being given to expanding the NFL beyond the current 32?
There's no real conversation. You know, our commissioner has addressed this question several times. I think the last time, maybe last Super Bowl. down the road, is there an international division of some sort? Perhaps, but there's no real conversation going on right now about expanding.
I ask because given the demand from institutional investors beyond the 4 that you approved to come in and make proposals to buy stakes, football and sports is an emerging asset class. So, there's not enough supply. There's plenty of demand, though.
There is plenty of demand, for sure.
So when you look across other leagues, what do you see as the single biggest benefit and also the single biggest drawback when it comes to allowing outside capital to invest in the league?
Well, we hope that we've addressed, if there are any drawbacks, we hope we've addressed them by being measured and starting off slow. I think probably one of the biggest issues to address is just making sure that your fans understand that it's not going to change the operations of the business. Again, going to your prior question, no say in the operations. People hear private equity and they think about that. They think about taking control of companies, et cetera. That's not going to happen here. So I think we've tried our best to make sure to communicate to the fans that none of this really changes. This is just financing for owners. It's an option to access new pools of capital for financing, and that's it.
What about sort of the longevity of that capital? Obviously, when you're dealing with investors and the nature, at least, of what private capital is, obviously they are long-term investors, but they're not necessarily buy-it-for-life investors that I think the NFL has been accustomed to for so many years. What was the discussion around the potential that there could be a churn in those investments much quicker than
great? It's a great question. As we've looked at this and studied this, going back to trying to predict market dynamics, one of the things we arrived on was liquidity expectations. And you're right, a lot of private equity firms, they typically buy and hold for a short period of time. One of our policy parameters is that they have to hold for at least 6 years. But even beyond that, the funds that we're talking about, these global funds, they have smaller funds within them. Some of them are longer duration, and some of them will be making the investments. So I think it remains to be seen. But I think that goes to what I said before about we see the program expanding down the road. If there's sales, we believe there'll be buyers.
I am curious about the league's stance on players, active players, taking ownership stakes in the teams.
Well, our current policy, the one that we passed yesterday, would not allow that. I mean, that is a concept that we've thought about, but I think we'd have to think a lot more about that down the road.
That was Joe Siclare. He is NFL Executive Vice President and Senior Advisor, and also the former CFO of the league. And thank God for that story and Nvidia's earnings today, Romain, because it's late August and there aren't a whole lot of catalysts in the market today.
Yeah, well, we're going to get them this week, of course. Nvidia coming after the bell tonight, and don't forget we get some inflation data on Friday during what's normally, I mean, given it's the last week of August, would be just a pretty sort of blah kind of day here. You take a look at the S&P. I mean, the good news is we're well off the lows of the day. Remember, it looked like we were headed for a pretty massive sell-off a little while ago. We still have about 14 minutes until we get there. And just keep an eye, too, on some headlines crossing the terminal there. The Telegram CEO now formally charged in France for the alleged criminal use of that Telegram app. Of course, something that we'll keep an eye on there. But, of course, all eyes really on Nvidia. We should point out Nvidia actually, too, one of the biggest drags on the broader market today.
It's down 1.5%. And of course, options indicate it's going to have a big move after hours trading and tomorrow, no matter what it announces. Also, Supermicro Computers, which is a distributor for Nvidia, the biggest decliner in the S&P and the Nasdaq 100, has delayed its financial results, its financial report. Yeah, absolutely. Here, and just going back to Nvidia too. I mean, we talk about the market impact. It's weighting in the various indices. So I was looking at sort of the options implied move. I think it's like 10%. Yeah. They were averaging coming into this quarter 8% moves up or down for the life of all the reports they've given. There were only 3 companies that even had an average higher than 5%. It was Microsoft, Alphabet, and I think Meta was the third here. So basically, you only have 4 companies that even have put these types of outsized moves on average, and Nvidia is still by far among them, despite the fact that, of course, I mean, it was kind of a smaller company just, I don't know, 2 years ago. I mean, has any company added this much market cap? It's been a straight shot up. Yeah, well, it went from a graphics, a computer graphics, video game processor to Bitcoin mining company, and now, of course, the poster child of AI. Yeah, of course, we're keeping an eye on that, and of course, we just mentioned the Telegram news there with the Telegram CEO being formally charged in France, as of course that deadline there in France for the authorities there to do something. We'll keep an eye on that case, but of course, as we march closer to these closing bells, with just a little more than 11 minutes to go, all eyes really are on
Nvidia, the outsized effect that it could have on the market trade in the cash session tomorrow. Kaminski joining us. She's the chief research strategist over at AlphaSimplex Group. Here to talk about, I guess, the broader market moves. But Katie, we got to start with, I guess, the micro move, and that is Nvidia here. Now, just talk about the importance of this right now, because it's been years. I can't remember the last time we had a stock here that had this much importance on one particular earnings report, the ability to either lift this market or completely tank it.
This is, I think, fascinating. And if you look at today, I think the thing that has been the most surprising is just how I think everyone's been expecting it to pop, and that generally expectations are positive, and today has been somewhat of a negative day. So I think that, to me, has been a little bit interesting. But just the fact that the market is so focused on this one stock, it tells us how vulnerable we are to some of these narratives. And tomorrow could be a very interesting day.
Well, that's what I'm curious about, too. I mean, there's been a lot of talk here about the correlations with Nvidia and the broader market. Our own internal analyst, Martin Adams, who leads our stocks team here at Bloomberg, she kind of pointed out that those correlations have come down. Now, they're still high. It's like 50, but it's not what it was just even a year ago here. I would think that would be a good thing, right? I mean, you want a little bit more of that sort of idiosyncrasicity or something. I don't know if that's a word, but you know what I mean.
Yeah, exactly. You want a little bit more idiosyncrasicity, I guess you might say. And what I would say is that, it just shows how much we've had a polarized and definitely crowded positioning, and that the market has been really focused on some key names, and those are driving a lot of volatility. I would point out that we have seen a lot of rotation with what has happened earlier this month and even in July. So I think that there is some sort of diffusion of that crowded behavior, but it does make us more vulnerable to individual data. And I think that's why on a week like this, that's pretty quiet, all eyes are on Nvidia today.
I like what you said about crowded behavior and giving rise to risks, and how that leads to over-positioning perhaps. Can you tell us a little bit about the other narratives that are out there, particularly as they affect other asset classes? And I think of, for instance, the carry trade unwinding, the yen being the carry trade that everyone focused on. How far along that narrative are we? Has that been resolved?
So I'm really glad you asked that, because honestly, from a trend follower's perspective, this summer has been a seismic shift. We've seen massive flux and changes in asset class positioning outside of equities that is more indicative of concern of a potential recessionary trade. Let me just give you an example. We've seen commodities go from long signals to much more short signals. We've seen fixed income signals go from short to long, and especially in the dollar. And given what happened earlier this month, the narrative has also changed there, that now signals are long FX currencies versus the dollar, so looking at a weaker dollar going ahead. So I think we are in a pivot where we're going to see very different behavior in the next few months, and cross-asset themes are definitely showing that things have shifted.
Different behavior in the next few months. Does that mean we might get delayed reactions to things, given that it's going to be pretty slow trading for the rest of this week and next week, of course, until after Labor Day and people really come back and are ready to get back to work?
Yes, that's correct, because September is typically a challenging month, and October for equity markets. And given the amount of uncertainty and all the focus on the pace, the size, and just sort of the timing of the Fed, I think there's going to be a lot of volatility, and the fact that the markets have really shifted more towards focus on economic weakness or economic growth, and just a very different narrative than thinking about inflation, which is what we thought about earlier this year.
But I mean, we're still not kind of past that, Katie. And I am curious. I mean, I know the market's already we're already celebrating the drop in rates. It still hasn't actually happened, but everyone's priced for it. And in fairness, the Fed has kind of signaled that they're going to do it. But is there going to be a fundamental shift, I guess, in allocation, in strategy, once we actually do see the whites of the eyes of those rate cuts, or is everyone already positioned around it already?
I think this is a good point, because for fixed income, it actually really still matters. Why does it matter? It matters because inflation is very important for long-term cash flows. So I do think we're going to see a lot of volatility around the yield curve. We're going to see potential for steepening in the yield curve, and that's something you typically might see as you see cuts. So I think that it's not over. It may look better now for inflation, but we could definitely have a pop back up in inflation that affects fixed income markets going forward, especially in the eye of cuts.
I am curious about macro conditions because part of this whole rate cut narrative and the idea that we might actually be sticking that proverbial soft landing that we've been sort of hoping for the last couple of years. But we've seen some softness in the economy. We've seen it in consumer spending. But I want to pose a question to you about what we've been seeing in the commodities market as of late. There's a lot of weakness there, particularly when it comes to oil. And I know a lot of this is kind of ex-U.S. more is what's driving that rather than what's happening within the U.S. here. But in the past, those types of drops and those types of softness that we see in industrial metals, in oil and other products have usually been a harbinger that something is wrong with our economy. Is that not the case this time?
So this is exactly an important point from a technical trader's perspective. From a trend following perspective, precisely what we saw in COVID, cross-asset themes tend to move first. So commodities, for example, short signals in commodities can be an indication that there's weakening demand. The fact that people are flocking to fixed income suggests that there may be more risk out there. So we're definitely seeing that there's more of that potential concern for equities. So the probability has been repriced for a potential recession going into the second half of this year.
Kathryn, what do you see as the biggest risk for the rest of the year?
I think it would be economic data that comes out as a surprise. Why? Because people are definitely at high valuations. If we start to see that this narrative isn't as stable as we thought, and that's precisely what we saw earlier this month, a little bit of indication that there's some economic weakness is something that might spook investors that perhaps cuts came a little too late. And that's why that's the thing I would be watching the most this fall.
So that following that, which assets are priced to reflect that possibility versus those that are not?
So this is probably more cross assets, so things outside of equities. Unfortunately, equities tend to fall last. What we do see is that commodity prices have priced in quite a bit of weakness, and you're also seeing the dollar also under pressure. Fixed income has rallied, but I think commodities is probably the sector to watch the closest, and that has been in a downward trend since earlier this summer, particularly some reversals in metals, as well as the energy prices changing directions as well. All
right, I just want to wrap this up, Katie, and we're going to kind of circle back, of course, to the thing that no one wants to talk about, which is Nvidia again. But it's more. This is more a question really about big tech and sort of these large mega cap names that have really led this market higher. As we sort of transition to a new rate cycle and maybe a new economic cycle, do you think we could potentially get a new market cycle that is broader and a little bit more diversified than what we've had over the last year and a half?
I would hope so. I mean, I think right now it's unclear how we get there because I felt that way in the last 2 months as we saw a lot of rotation. But I guess if we start to see an environment where things stabilize, where lower rates helps companies, you might have a scenario where small cap companies can do well, and you might continue to see that rotation. So I think the question is going to be how do cuts impact the economy overall, and how do companies react to that? So it is possible that we could have a little more broadening in that scenario.
All right, always a smart conversation. Going to have to leave it there. Katie, Dr. Katie Kaminski, Chief Research Strategist over at AlphaSimplex Group, helping us count you down to those closing bells. Less than 3 minutes to go here. And we have a slew of earnings, Scarlett, coming after the bell, including NetApp, including Okta, Salesforce, CrowdStrike, Victoria's Secret. Am I forgetting one?
Yeah, there might be one.
Oh, okay. I think Nvidia. Yeah, obviously that is really going to dominate the conversation. But it raises the question, too, and we're taking a look at some of those names right there on the board.
Mm-hmm. You included HP as well, which is another tech company that, former tech giant and now less so. One thing that's interesting about Salesforce, of course, is what it says about perhaps further acquisitions.
All right, a full breakdown of all the market action and, of course, all of Nvidia coming right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you through the Closing Bell, a global simulcast. It starts right now. Carol Massar and Tim Senovic joining us in the radio booth. Alex Steele, she was just too afraid of those Nvidia earnings, decided to take the day off.
She's not
here.
afraid of
But
anything.
we welcome all of our audiences across all of our platforms here, including our partnership with YouTube, on what I'm told, Carol Master, could be the most consequential day in the history of America.
Oh, man. Okay, now you're like pushing it. But it's an important one for the markets. We know that Nvidia, what happens in terms of earnings, how it trades, it has impacted the trade overall, the equity markets a lot. The sell-off that we saw in Nvidia and then the big bounce back. You can even, I feel like you can see it in the lead up to it, like the volatility that we've seen in the markets overall today, Tim.
It's not just Nvidia, though. I mean, certainly a big story.
It is about Nvidia.
We're still getting earnings.
Yeah, but it's still about Nvidia. Too.
Yeah.
Oh, come on. We got
Romain,
Salesforce.
tell him it's
we got
about
Okta. We're gonna hear
Nvidia.
from
I'm actually-
CrowdStrike. We're going to hear from a firm a little later. There's other companies out there.
Firm's not going to move the market like Nvidia does.
Come on.
That is true.
Come on, guys.
Well, I mean, all
Are
those.
you going to back me up a little bit?
I actually do back you up here. I mean, look, I mean, we talk about the
bros stick
outsized
together,
importance
man.
of Nvidia because of its weightings, but of course, some of those other companies you mentioned, of course, will give us a little bit of a better read about kind of economic conditions. Nvidia is kind of in its own world, and we talk about this idea here that when you have a company that's so outsized in the market here, how do you push back on that if you're an investor? Do you just go along for the ride? This is sort of like don't fight the Fed, don't fight Nvidia.
You have to go along for the ride because, I mean, if not, then you're going to underperform, and that's the risk out there for any active investor.
All right, we're going to walk you through all of those earnings, including Nvidia. So let's get right to the numbers here on a closing basis. Everything pretty much in the red across the board. The Dow Jones Industrial Average down more than 100 points or 0.4%. The S&P down more than 30 points or 0.6%. The Nasdaq is going to close out the day down by more than 1%, and the Russell 2000, Carol Masser, closing the day down by about 0.7%.
All right, so a little bit lower. So back to the big caps I go, guys. You had about 214 names in the S&P 500 actually gaining ground today, 285 losing ground, and then Scarlett, you had 4 unchanged.
All right, let's take a look at the IMAP. It's going to be pretty much a red pizza pie. A little bit of green there. The only green really is in the financials and the healthcare space, and they're marginally higher. The big laggards on the day, tech, consumer discretionary, and communication services, which basically encompasses the Magnificent Seven. You've got consumer discretionary and tech each down at least 1%, Carol.
All right, guys, to some of the individual movers. We have Chewy up about 11% today, rallying to the highest in about a year, to its highest, I should say. The company came out second quarter results and gave an outlook that was positive. We've got some earnings. We probably should go to them.
Let's do Salesforce now, crossing the wire right now. In its most recent quarter, sales coming in slightly above estimates at about $2.07 billion. The street was looking for $2.01. Operating income beating slightly here, $3.14. The street was looking for $2.96. EPS also a slight beat at $2.56 a share. Here's your forecast for the full year. The company is guiding revenue $37.7 billion to $38 billion. That's the range that it's giving. The street was looking on average for $37.8 billion here. So relatively in line with estimates on the forecast and a modest beat, guys, for the most recent quarter.
All right, let's take a look at NetApp, which is a storage company, so it's hardware. And NetApp reporting for the quarter that ended, EPS that beat analyst estimates, $1.17 for the quarter. Excuse me, that is on a net basis. Adjusted EPS, $1.56 versus a consensus estimate of $1.45. Revenue also topping the average analyst estimate. As for this quarter, it sees net revenue of anywhere from 1.57 to 1.72 billion. The consensus estimate is 1.62 billion, and NetApp still sees full-year adjusted gross margin of 71 to 72%. The stock not moving yet in after-hours trade.
Okay, I'm taking a look at shares of Okta. They're not moving in after-hours trading either, but second quarter adjusted earnings per share did beat estimates. EPS came in at 72 cents versus estimates of 61 cents. Revenue was up 16% year over year. It came in above estimates at $646 million.
All right, we do want to go back to Salesforce, of course, at least for right now. That is the biggest company reporting out there here. The president and CFO of the company, her name's Amy Weaver. She is stepping down from the company, though she will remain CFO until a successor is named. I'm not quite seeing the reason for her departure here, but of course we do know there has been a lot of talk here about the C-suite up there at Salesforce, whether some of the folks there were aging out, whether they needed to change. Amy Weaver, the president and CEO, going to be stepping down once a successor is found for her position.
Yeah, it looks like she was named CFO back in early 2021, so been there for a few years. Let's go to to another one crossing the retailer Five Below, guys, coming out with its latest results. Let's go to the outlook. Fiscal year adjusted EPS, $4.35 to $4.71. Looks like it's opening a little bit of that range. The estimate out there is $4.75, so that's below that. The stock, though, is up almost 4% here. Third quarter adjusted EPS, 10 to 22 cents. Estimate on the street is 15 cents a share. Third quarter net loss of $2 million to $13 million. And third quarter net sales of $780 million to $800 million. The estimate on the street is $790.2 million. And let's go to the second quarter. Last quarter, what it did, second quarter EPS, 60 cents a share, and that's 6 cents better than what the street was expecting. And Scarlett, you've got that stock rallying about 5% here.
Yeah, Five Below up 5%. Of course, they sell affordable items.
Nice. Five Below up 5%.
No, oh, I didn't even think about that. Yeah, you're right. They do sell
That's
affordable
why I'm here,
items.
for useless facts.
Keep them coming. You know, any company that delivers value to a consumer is in fashion right now. I'm just looking at the overall after-hours trade right now in terms of most active stocks by value, and Salesforce up almost 2%. But the other names that we've gone through, you're not seeing a whole lot of activity in those companies in after-hours trade. Nvidia, we should mention, up marginally after declining in regular trading before its results come out.
Okay, so now as investors have had a chance to check out shares of Okta and the results of Okta, shares down about 3% in the after hours. This does come after the company reported its latest results that did show that it beat on the top line and on the bottom line.
I am curious, guys. I mean, obviously, we're kind of biding time here until we get to those Nvidia earnings here. And there's been a lot of talk here about the weighting in the S&P, almost 7%, 11% in the NASDAQ Composite, 14% in the SOX. So it doesn't matter what this stock does. It's going to move the broader market. We're getting some other earnings right now.
All right, so let's get to them. We've got CrowdStrike crossing the Bloomberg terminal. Let me just bring it up here on my terminal. And you've got CrowdStrike. Second quarter revenue, folks, it's a slight beat, $963.9 million compares to the estimate of $958.2 million. Second quarter adjusted EPS, also a beat, $1.04. So that is 7 cents better than what the street was expecting. Nonetheless, right now you're looking at CrowdStrike down about 0.8, about 0.5% here in the aftermarket.
Yeah, I'm just looking at the comments here, and they did have a comment here about in response to rising point productivity complexity. Boy, that's a lot of corporate talk. And an elevated threat environment, organizations increasingly focus on consolidating their cybersecurity vendors into a streamlined platform that delivers better security outcomes, which is CrowdStrike Falcon. Again, the big issue for CrowdStrike this past quarter was what happened with its systems and how it brought down Microsoft. For it felt like every industry.
Yeah, they refer to that July 19th incident at the top of the press release. They said, working with customers to recover from the July 19th incident, we emerge as an even more resilient and even more customer-obsessed CrowdStrike, continuing to aggressively invest in innovation. The big question I think a lot of investors have about that is, to what extent do CrowdStrike customers end up going to competitors as a result of that outage that just affected so many different industries?
All right, also getting some news in terms of the outlook, guys. The company CrowdStrike sees fiscal year revenue of $3.89 billion to $3.9 billion. So it's reining that in. It had seen that fiscal year revenue outlook at $3.98 billion to $4.01 billion. But nonetheless, investors are like, okay, right now the stock's up about 3% here, remain in the aftermarket.
Yeah, absolutely. And actually, I'm kind of glad we had a chance to go through some of these. I know they're kind of second tier compared to Nvidia, but we talk about all these names basically kind of in that broader software tech space, and you are getting a better sense here of the health of these companies, and more importantly, the health of corporate spending, and that, of course, is going to be a big theme when we get to Nvidia. We know they're making a lot of money. We know they have revenue growth here, but we've already heard from some of the big hyperscalers that they have taken a closer look at their AI spend and decided that maybe it was a little bit too much too soon.
You know, that's funny that you bring that up, too, because I was thinking about, we had a conversation with Ian King, and he was talking about specifically for Nvidia, when I'm just pulling up the supply chain function analysis on the Bloomberg, and that when you've got a company like Microsoft that's already 45% of their CapEx spend is Nvidia. Meta, it's 41%. How much more can they get from their big customers? It's something to think about what the future spend is and how that impacts Nvidia and their top line going forward.
I don't want to cut into your long goodbye, but that's a great point. And I really encourage everyone to do that. It was an SPLC, because I was looking at that this morning too, and I didn't realize how much of Nvidia's revenue was dependent on basically just 5 big tech companies.
Exactly.
It was like more than 50%.
Super microcomputer.
Yes.
Like a who's who of big tech, right?
Yeah.
Yeah.
Aren't you glad I
it's a little smaller
stretch
tech
out
now
these
after today's
goodbyes
sell-off.
and I bring you added
Still pretty
information?
big tech.
We didn't get to the decliners, but Supermicro was top of the list for me, guys.
All right, Nvidia, guys, just up about 1/10,
Sam.
unchanged in the aftermarket. You know what, Scarlett, I'm with you. I'm just going to say I'm with you. All right.
Look at that.
Nvidia to come,
Nepotism.
everybody. All right. That's a wrap for cross-platform radio, TV, YouTube, Bloomberg Originals. We both, on both sides, watching for those Nvidia earnings. But the team will see you again, same time, same place tomorrow.
And the clock is still ticking. We are waiting for Nvidia. We will have a full breakdown of those results the second they hit the wire. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Stocks on the back foot on the day here. The volume was light as everyone is waiting, of course, on those results out of Nvidia. In S&P 500, the close lower on the day, but well off the lows of the day, down about 0.6%. But you see the Philadelphia Semiconductor Index, a 2% drop on the day, a big drag from Nvidia as a lot of folks trying to front run those earnings. If you're looking for a bright spot, you'll find them in the financial stocks and you'll find them in utilities, not necessarily a harbinger here of further broad market gains, Scarlett.
Yeah, you really had to look for some gainers, but I did fail to find one. And I thought I should have in Abercrombie and Fitch because it had a beat and a raise on the top line, but that was not enough to impress investors, mainly because Abercrombie and Fitch has almost doubled this year. It's consistently topped estimates, and investors hold it to higher standards than most retailers. The negatives in the earnings report were that gross margin was slightly below estimates. And Super Microcomputer down 19% after saying it's delaying its annual financial disclosures after short seller Hindenburg Research published a fairly critical report on the company. And of course, we can't get too far away from Nvidia. It is moving in after hours trading by not a whole lot, down 0.25% in contrast to the options, which indicate much larger moves once the earnings hit.
Yeah, that could change in a big way in just a few minutes. Right now, though, one of the biggest movers in after-hours trade is Affirm. Those shares up about 15% here on the back of its earnings report here. $659 million in revenue in its most recent quarter. That's its fiscal fourth. That's a beat. It's still posting a loss of about 14 cents a share, but that is actually better than what the street had anticipated here. And here's your guidance. The company is saying that it sees fiscal 2025 gross merchandise volume above $33.5 billion. The street was looking for $33 billion. So basically it's guiding, Scarlett, above what the street was looking for full year gross merchandise volume, and actually says that revenue for the first quarter, this is the quarter that it's in right now, will also top estimates. They're providing a range of 640 to 670 million. The street was looking for 632.
Yeah, this is one of the big buy now, pay later vendors, companies. And so this really suggests the adoption of BNPL, buy now, pay later, among young people, among consumers overall as the economy slows down further.
Yeah, Affirm also saying expects to be profitable on a GAAP basis in the fourth quarter of this year. It's something we don't hear about anymore. I thought GAAP was dead. All right, we are keeping an eye on another stock, and that is Salesforce. Those shares higher here in after-hours trade. That company beating on several metrics in the most recent quarter and providing guidance for the quarter and the year that is trending also above what the street was looking for. Anurag, Rana out in Chicago over at Bloomberg Intelligence joining us now. And Anurag, what was kind of the more consequential thing that we learned out of the earnings report from Salesforce?
I think the most consequential thing I learned was things are not really getting worse at this point, and they were marginally better. And that's actually good news because we have seen from companies like Workday that clients are really not adding a lot more seats, and there is pressure on your traditional software businesses at this point as clients are moving a lot more of their funding towards buying GPUs.
Exactly. And of course, Nvidia results, we're still awaiting those in about 5-6 minutes. Talk a little bit about actives and investors and how they've changed the focus of Salesforce, certainly to focus on profitability and straying away from its previous strategy of buying growth.
Yeah, I think that is single biggest thing that we have seen improved over the last 2 years, and you can give the outgoing CFO some benefit there because she has done such a good job of managing margins. company's margin structure has changed completely, in part because of the activist pressure. There were some rumors about M&A, and that is slightly concerning. But other than that, I think Salesforce is in the right trajectory in terms of profitable growth. And when we assume if tech spending comes back next year, then we would assume the top line to improve as well.
This might be a weird question, Anurag, but has there been any issue with Salesforce maybe losing some of that corporate spend to all the hype around AI and all the sort of ancillary things that go with it?
Yeah, definitely. I mean, that is the big story here for all the top software companies is if you're really not a pure play AI company, then you are losing that funding towards, people buying chips or Microsoft processing more transactions on their cloud. Companies like Workday and Salesforce have suffered because of that.
All right, Anurag, really appreciate your joining us for the latest on Salesforce. Anurag Rana of Bloomberg Intelligence. HP also reporting earnings. Let's just give you the numbers here. Third quarter net revenue, $13.5 billion, beating the consensus estimate of $13.37 billion. In terms of its outlook, it sees full year adjusted EPS of $3.35 to $3.45. That is a higher range than what it previously anticipated of $3.30 to $3.60. And at the high end, it matches the average analyst estimate of $3.45. The stock, however, lower by 5% after hours trading remained, even after it boosted its share buyback authorization to $10 billion.
Yeah, fire hose are earnings coming out here in the after hours trade as we continue to wait on Nvidia. We did get results, though, out of a couple of key cybersecurity companies, including CrowdStrike. Okta also out with its earnings as well. Mandeep Singh at Bloomberg Intelligence joining us now in Studio 2. Let's start with CrowdStrike because, of course, they had a little bit of an incident a few weeks ago here. What did you make of the results and, more importantly, the response to what happened?
Yeah, I mean, everyone was expecting they'll give a much lower guide for the second half, reset expectations. Well, they haven't done that. They told us it'll be $30 million impact for the next 2 quarters. So net, it's like 150 basis points in top line revenue that they expect from the outage. But other than that, they are sticking to their guide, which I'm surprised by, honestly, because this was a big event. If Delta is saying they had a $500 million impact, there are other customers like that, and they clearly seem to be downplaying, what customers may be claiming down the line.
Why do you think that is? Is it because of the after-sales service that CrowdStrike is providing its customers?
I think that has to do with it. Remember, they are the category leaders in endpoint cloud security. So clearly, they had a very good market position, and they were able to convince some of their customers. And maybe they have got insurance, for the incident. But the initial hunch that I had was, given the magnitude of the losses some of these customers had, the insurance isn't going to cover all those losses. And so they are better off sandbagging the second half guide. Clearly, they're not doing it, and they are still sticking to, the 25 to 30% top line growth.
Those shares getting a little bit of a boost in after hours trade. I want to talk about Okta because those shares are actually moving lower here. Kind of explain what's going on with this company.
Well, so if you roll back 6 quarters, they also had a security incident to their systems, and they never recovered. Since then, the top line growth has been decelerating, and even till date, it's been the estimates have been coming down, and that's what I'm surprised by. The precedent suggests that when a security company has an incident like this, it takes at least a few quarters to recover from that. So if CrowdStrike is suggesting they're already thinking about a rebound and, there won't be much impact, I'm honestly surprised by their guide.
Okay, because you think maybe we could see a repeat of what happened with Okta? Maybe?
I mean, and Okta's event wasn't even of this magnitude, even though, it wasn't an outage, it was more of a security event, but it wasn't of this magnitude. So.
All right, we're going to have to leave it there. Mandeep Singh, always appreciate him jumping on to cover these earnings as soon as we get them. Of course, the best of Bloomberg Intelligence. Our thanks to Anurag Rana, as well as now the clock officially ticks down to those results out of Nvidia. We're expecting to get them any minute now, Scarlett, and to say that the palpitations are extreme would be an understatement.
Yeah, absolutely. And I think we have to keep in mind, as much as they're consensus estimates, they're definitely whisper numbers that are being bandied about here. We heard from Daniel Morgan earlier that the third quarter revenue outlook, which is for this quarter, he's hearing a whisper number of 33 to 34 billion, even though the consensus estimate is for 31.9 billion, so just under 32 billion. That will be critical.
Yeah, it will be critical. And it gets to this idea, too, of what are the expectations. I mean, when you have a company that was growing, 300%, then 200%, and now this quarter is going to be 100%.
I know,
which
only 100%.
Under any other circumstance would be phenomenal. But of course, people want more and people want growth. And how much of that growth has already been priced in?
Yeah, and you get harder comparisons going forward, too. So that deceleration will continue.
Nvidia earnings now crossing the wire, and here's your number. It is a $30 billion number on the top line. Revenue in the most recent quarter, $30 billion. Even the street was looking for 28.86, if you want to be precise. Adjusted EPS, 68 cents a share. Gross margin, 75.7%. That's a beat of what the street was looking for. The company also saying that for the third quarter, the quarter that we're in right now, it expects to post, get this, Scarlett, $32.5 billion in revenue, plus or minus 20%. That is well above what the street was looking for, which was roughly around that 31.9 billion number. So if it gets that number or gets the plus 2%, certainly a big beat there. The company also approving $50 billion in share buybacks.
Right, but the whisper number is the number that maybe we should be looking at. And yes, even with that increased forecast, it's not at that $33 or $34 billion. Perhaps with that plus or minus 2%, you get closer to that, but it's not quite at a 33 handle or a 34 handle. The stock moving up marginally in after hours trading right now. And it's all about the forecast and whatever it says about Blackwell. During the conference call as well. So keeping an eye here on Nvidia shares, let's now bring in Antoine Chkaiban. He is technology infrastructure analyst over at New Street Research. He has a buy rating on the stock. Antoine, what do you see in these results that perhaps are encouraging when it comes to the outlook?
Thanks a lot for having me. I would say the results are directionally aligned with our expectations. I would say it was actually legitimate to expect Nvidia to do better than they guided 3 months ago and guide above expectations as well for the next 3 months. On one hand, you have hyperscalers who are increasing capex. Revisions keep going up. On the other hand, you have supply chain that is increasing capacity steadily. You know, we have data points on the CoWoS front, we have data points on the HBM front. So all that actually lined up very well and tells us that actually it's reasonable to expect Nvidia to keep beating for the foreseeable future. Now the question is what happens beyond 2025, and I don't think we'll have any visibility on that anytime soon.
Okay, well, let's give you some commentary from the company on when it comes to Blackwell. Nvidia saying that Blackwell samples are shipping to partners and customers, and anticipation for Blackwell is incredible. I know that doesn't begin to give us any numbers to work with here, but given that there were reports, Antoine, of some delays and design issues with Blackwell, do you see enough demand for the Hopper chips, the current generation chips, to kind of make up for the elevated expectations for Blackwell?
Yeah, so I think so. Nvidia can actually mitigate the situation in many ways. As you mentioned, they can extend the life of Hopper while Blackwell ramps. As you know, Hopper uses only CoWoS-S packaging. That's now a mature platform. It's easier to ramp in larger volumes, so that can definitely offset a delay in Blackwell. And we could also see a single die Blackwell chip that could use only CoWoS-S packaging as well. It would have lower performance than the dual die Blackwell SKU, but that would still be an uplift versus Hopper. And so at the end of the day, we still sense enormous and urgent demand across the board. And that really mitigates, in our view, the risk of a pause in shipments as customers wait for the next generation of chips to be available in volumes.
Give us a sense here when we talk about how NVIDIA sort of capitalizes on all this. And I'm not just talking about the revenue they're getting from the chips coming in, the new orders coming in, but the long-term capitalization. What does Jensen Huang do? Or more importantly, what do you want to hear him articulate about how he ensures that this upswing that we've seen in this company for the past 2 years is permanent?
Yes, so I think what we want to hear is the fact that all these investments that have been deployed over the last few years are actually getting deployed for use cases that are going to drive sustainable monetization. And I'm not sure actually that Jensen is going to be able to convince us in the near term. That's what I meant earlier. I think we're going to have to wait a bit further and see maybe as we move into 2025, whether we start to hear from the companies deploying those chips, and so you have the hyperscalers in particular, Microsoft in particular, whether we start hearing from these companies tangible monetization. And we've done a lot of work actually trying to evaluate where those chips are getting deployed today. Are they deployed in the public cloud? Are they deployed for internal use cases? Are they deployed to help AI startups train foundation models? And I think we're going to start to hear and see convincing arguments that these chips are getting deployed in ways that are going to start driving revenues.
Yeah.
And I don't think something we'll hear right now. I think this is something that's going to be much more progressive over the next few quarters.
It's interesting in the release, too, and in the investor presentation on their website, Antoine, they kind of lay out a lot of the things they are trying to do to sort of, I guess, diversify product revenue. They talk about doing more fab work and a few other things as well. I mean, you're looking at the revenue. This is still a data center-driven company, $26 billion of their revenue, so the lion's share of it. They're still getting about $3 billion from gaming, and then after that, it drops off. Do you want to see more diversification in product lines? Do you want to see more diversification in strategy? Or are you happy with this data center all-in strategy?
So I think we can see diversification actually within data center. We can see diversification within data center on the customer front. At the moment, you know that hyperscalers, like a handful of companies, actually account for about half of NVIDIA's revenues. We expect diversification to happen on the customer front. There, we expect tier 2 clouds to represent a more significant portion of data center revenues. We expect cloud, like sovereign AI, to actually represent also an increasing portion. We expect enterprises like Apple, like Biden's, and others to actually start ramping significant clusters as well. And so that's one thing I would say. Then, of course, you have gaming and automotive that keep growing. Automotive probably presents a significant opportunity, but it's probably not something that's going to impact the stock anywhere in the near term.
All right, going to have to leave it there. Antoine, really appreciate you jumping on to help us break down these earnings in real time. Antoine Chkaiban over at New Street Research. And we should just point out we are going to have a special interview and special coverage later tonight, a sit down with the Nvidia CEO, Jensen Huang. That's going to start at 6:30 p.m. Eastern time right here on Bloomberg. As we see Nvidia shares now deeper in the red here. They were down as much as 4%, now down about 2 to 3%. But you know what's phenomenal to me, Scarlett? 384 million shares have swapped hands right now on the back of this earnings report. That's phenomenal.
Conference call hasn't even begun yet. We haven't even heard the gist, the bulk of the comments from the CEO on their outlook and how they put it together in a narrative.
And we talk about sort of the broader market effects here. You are seeing futures overall be dragged down by this. Also seeing some peers like AMD, ARM, TSM, and a few others also moving lower here. Stick with us. We're continuing our coverage of NVIDIA's earnings. A conversation with Dan Newman, CEO of Futurum. That's coming up next, right here on The Close on Bloomberg. Nvidia earnings are out here, a beat on the most recent quarter, though the forecast that the company gave, maybe not quite what investors had expected. You're still talking about a company sitting on $30 billion of quarterly revenue. But as we know, when the company grows as much as it has over the last 2 years, sometimes enough is never enough. Daniel Newman joining us right now, the CEO of the Futurum Group, to talk a little bit more here, I guess, maybe about the long-term prospects for this company. I mean, look, Dan, if you need a chip that can sort of power these data servers, that can sort of be at the focal point of what you need to crunch these numbers, to be at the center of AI, you have to go to Nvidia. That's going to change at some point. They're going to have competitors, and they're going to have meaningful competitors. How soon do you think we're going to start to see that competition?
NVIDIA is off to a fast start, and of course, more than a decade of research and investment that went into building this platform. It wasn't just hardware. You're not buying a GPU. You're buying a system. They're putting it all together, the software, the libraries, the frameworks, and they've made AI accessible, enabling developers to write programs to this hardware that's really powered this whole movement. But let's be honest, Romain, AMD is going to enter the fray in a big way. We're seeing what Lisa Su is doing. And of course, we're seeing every hyperscaler, whether that's AWS with Inferentia and Trainium, whether that's Microsoft Maya, Google's training its newest Gemini models on its TPU, they all want to enter the fray. They understand the importance of building this vertical integration, but I do think it's going to come slow. So, this was a clean quarter. NVIDIA did what it said it would do, but the market doesn't want 100%. They want 150, 200% acceleration of growth. They want to know AI is going to land and Blackwell is going to be right on time, because that's what has made this a $3 trillion company.
It's interesting when we look at, I guess, what NVIDIA says and how they characterize it in their presentations, but also with some of the folks we've spoken to in this program. They basically said that right now there is no demand issue. The demand is there and it is ample. It is right now still a supply issue. And as long as NVIDIA doesn't necessarily have an AMD or TSMC or some other company capable of providing comparable chips, this is still their world, isn't it?
Yeah, this is not a demand issue. Of course, we are looking at that longer tail. We've seen the comments from Goldman, the comments from Sequoia on whether or not AI is being deployed at the enterprise level, financial services companies, hotels, or restaurants and retail using this stuff. But these CapEx investments, you heard from Satya, you heard from Sundar, Mark Zuckerberg, they're not going to slow down anytime soon, but they are going to hedge. So back to your last question, Romain, they are going to build their own accelerators. They're partnering with companies like Broadcom to build these XPUs, which we actually see growing faster than these GPU systems, according to our intelligence. And over time, as we see inference become the killer workload, rather than so much focus on training, we're going to see different architectures of chips start to play a really meaningful role in this AI, this AI build out. So I see it both ways. I think for the next 3 or 4 quarters, NVIDIA's in the driver's seat. And if they do things right, they're going to have so much market share that you think about what Intel had with its CPU business in the data center, they're going to be in a great position. It's going to be their market to lose.
Okay, so I just want to go back for a moment to what investors are reacting to right now, which is the outlook for this current quarter. Nvidia says it sees revenue this quarter, third quarter, of $32.5 billion, plus or minus 2%. The consensus estimate was for $31.9 billion, so just under $32 billion, which would already be a 76% jump versus last year. The highest estimate, though, was just under $38 billion. So, Daniel, when we look at a company like NVIDIA and the kinds of stock moves it's had, up 160% this year, up 35% since its last earnings report, investors want to see it delivering in every way, on all cylinders. Is it a case where anything other than the highest estimate would just automatically get some kind of a pull down? And in order for the stock to attract investors once again, the commentary on the conference call really has to outperform?
Yeah, we've seen so many quarters in a row where they've come and beaten substantially above even what that sort of guide was. And over the past several quarters, we're starting to see, the deceleration quarter on quarter and year on year. And that's because they've had those massive 300% and 400% growths.
Yeah.
Now, what we're really up against is, we are up against whether or not this is sustainable. Do investors want to get out after making 1,000+% returns? Are they looking at this and saying, maybe we'll let it cool, we'll let it breathe? And I said this coming into the quarter, Scarlett, there was no result other than perfect that would probably create a big lift. But there was a lot of downside, not just for NVIDIA, the whole market, if they didn't come up big. And I think futures are showing that as well.
So NVIDIA is really the only game in town right now when it comes to these AI chips to power data centers. We know that NVIDIA has pricing power and therefore it has margin power. Do you therefore look at the gross margin number as an accurate gauge of demand for NVIDIA chips? Or is it not all that sensitive because the pricing is not dynamic?
Yeah, I think the margin power is indicative of the influence that NVIDIA has. Of course, it has its large partners. It's building systems, not necessarily selling just a chip. It's systems, and these system margins are very high because the demand is substantial. We're hearing everyone from OpenAI to other smaller enterprises and tier twos having a problem getting access to the chips and systems that they need, and therefore companies like Meta, X, Tesla, Microsoft, Amazon taking all of that demand, and it gives them great pricing power. I don't think until AMD really starts to see acceleration in its business, and then to some extent when these hyperscalers start to really see growth in their homegrown platforms, is Nvidia going to be under substantial pressure to play in the pricing battle? But I do think over probably 4 to 8 quarters, we're going to see some pressure on margin, and that is going to be something to watch.
Yeah, absolutely. And we should point out our team here that's been crunching all these numbers in there now pointing out this is the smallest top line beat that we've seen for Nvidia in 6 quarters here. Nevertheless, still, again, we always have to point out almost triple digit growth here, which would normally be something to celebrate. Dan, you mentioned the hyperscalers. I am curious about the end use cases for AI, because ultimately that will probably determine the longer term growth for Nvidia and some of its peers here. Even past the hyperscalers, when do you start to see a more meaningful use case for AI and a meaningful use case for AI that's actually going to be profitable for the companies doing it?
Yeah, we're starting to see them, Romain. We're seeing it with Walmart. They announced some pretty substantial efficiency gains in their systems just in this most recent quarter. We heard Andy Jassy talking about some of their code development and the efficiencies, talking about, years of developer time that was able to be reduced because it was because of what they've been doing with generative AI tools for code development. But that is exactly where my head is at too, Romain. I mean, building this into Salesforce instances, they had their earnings today. Mark Benioff's going to talk about this, but companies and their CRM systems, can they get better understanding of when customers are going to buy and getting them the right message in the right channel at the right time and using generative tools to do this? We all want to see this digestion of all this CapEx turn into really meaningful consumption on the OpEx side. And that's happening more slowly. I've been saying to the market that I think this is a 4 to even 12 quarter lag, depending on industries. But we are getting value out of AI. So that's also kind of a misconception. We've been using AI. Algorithms are 4 decades old. We've been optimizing. Bloomberg's been using it in its own assessments for a long time. But generative tools need to bring more value, and we need to understand monetization better in these next quarters for more of these software and SaaS and other businesses.
As opposed to just betting blindly, which is what so many people have been doing. Daniel, really appreciate it. Daniel Newman is CEO of the Futurum Group. And of course, as we look at Nvidia shares decline in after hours trading, just a reminder that we have a special edition of Bloomberg Technology. We've got an interview with Jensen Huang, the CEO and co-founder, tonight at 6:30 p.m. Eastern time. In the meantime, it's worth revisiting that markets were down, equities were down in the lead up to these results. The S&P 500 lower, the NASDAQ 100 lower by even more. Not much movement in treasuries or the dollar for that matter, up slightly by 1/3%. But right now the setup, Romain, is that at least heading into the earnings call that it did not deliver the highest expectations.
Yeah, and we'll see what that effect is on the cash session. We should point out that right now S&P futures are down more than 10 points from where they closed out the cash session, and the NASDAQ futures down significantly more than that, down about 100 points or so. So it'll be interesting to see. There you have it there on your screen there, the S&P, NASDAQ, and for those folks that will still follow it, the Dow futures. And this will be, of course, the big story in the morning here is just how much of a drag Nvidia has on the broader market. More coverage coming up. Stick with us. This is The Close on Bloomberg. We continue to keep a close eye on shares of Nvidia, and we will get back to that story in a minute. But you'd be remiss in not pointing out, of course, that this is still a macro-driven market and one that actually could be driven in a big way over the next couple of days. We do get quite a few points of economic data, including a revision on GDP numbers tomorrow. And on Friday, the Fed's preferred measure of inflation is due out, core PCE. That is expected to hold at 0.2% on a month-over-month basis. A big question now as to what that will mean for the Fed's rate-cutting dreams. Tiffany Wilding joining us right now, economist over at Pimco, to talk a little bit more about this. And before we get into the numbers of these specific data points, I'm wondering kind of what your broader assessment is right now of the economic environment against this backdrop of what the market is expecting, which is several rate cuts over the next 3 months.
Yeah, no, I mean, I think if you really just zoom out, I think what we're seeing is a U.S. economy that is getting back to, some semblance of normal after the very unique set of economic shocks that we saw post-pandemic. So again, if you just zoom out, you look at headline inflation levels, we are pretty close to the to ranges that where we were pre-pandemic. If you look at labor market indicators, including the unemployment rate, or if you look at the job openings to unemployed ratio, we are back to levels where we were in 2019. If you look at measures of wealth in the economy, which exploded post-pandemic, real wealth is now back to levels that we were in 2019. You know, measures of supply chain stress are back to where we were in 2019. You look at inflation expectations, they've remained well anchored throughout this whole episode. So I think if the question is, if we're kind of getting back to, you know, more of a pre-pandemic type of economy, why are we not closer to a pre-pandemic level of interest rates from the Federal Reserve? So, you know, all of that is to say is that, you know, policy is restrictive, you know, given underlying economic conditions. Central bankers, Powell clearly knows this. I think that the way, you know, the way he communicated at Jackson Hole, he was very clear that the Fed is moving towards neutral. They know they need to get there, and the question now is more about the pace, you know, than it is whether they're going to go there or not.
But there is also a question about what neutral is. I mean, I like the fact that you sort of talked about how we've kind of renormalized, if you will, back to some of those pre-pandemic levels. But does that necessarily mean that interest rates have to go back to those pre-pandemic levels? Because there are a lot of Fed members that will say that what we had back then was not normal.
Yeah, I mean, and I definitely take that point. And that's something for sure that Federal Reserve members will have to try to understand and estimate in real time as they're reducing policy. And it certainly is a reason why, absent a recession, if we are not in a recession, you know, that they can still take some time to get back to, you know, levels closer to what they estimate is neutral, you know, knowing those estimates are uncertain. So I think that's what they're thinking they're going to do. I do think, you know, when you bring in the distribution of risks here, you know, I think that also matters. You know, the fact that, as Powell suggested, just upside inflation risks have moderated, you know, and there are signals within the labor market report, within the labor markets, you know, that do suggest that labor markets have eased quite a bit. And obviously, you know, usually those things have momentum that builds on each other. At least they have had historically. So when you see an unemployment rate that moves up over 50 basis points, that tends to result in a bigger move up in the unemployment rate. So within that balance of risks, you know, we would still argue the Fed has some room here, you know, to start cutting interest rates, see how the economy responds, and then revise their level or their estimate of neutral, you know, as they do that.
So a gradual, methodical approach here to policy and how the rate cuts, the loosening of monetary policy gets handled. How in sync is the bond market and Fed policymakers now when it comes to the outlook for rate cuts for not just this year, the rest of this year, but next year?
Yeah, well, I mean, if you again think about, you know, kind of just the distribution of risks here, you know, the SEP forecast is a modal expectation. It's the most likely expectation. And Federal Reserve officials themselves have suggested that, you know, really the risks around the inflation and the unemployment rate goal would suggest that, if anything, the risks to that policy rate forecast are to the downside. And so, you know, I think what the market, you know, is kind of pricing right now is we kind of have this modal expectation that, as you said, things will be methodical in how they get down. But there's always a range of scenarios, right, that the markets will price. And there's certainly the risk that they could get there a little bit faster than that. Or, of course, in the case of a recession, you know, a lot faster. So, you know, again, I think that's kind of what the markets are pricing. You know, overall, when we look at valuation across the bond market, you know, we still see a lot of value despite the you know, the recent rally. You know, if you look at five-year real interest rates, for example, at around 170, you know, they're still well above levels that we think are more consistent with real neutral interest rates. You know, even if they are a little bit higher than where they were pre-pandemic. So again, I think all of this sort of suggests that you know, the bond market's still an interesting place to be.
It's still an interesting place to be, but people are very comfortable with the idea of socking money away in money market funds or T-bills and just hanging out and getting that 5% return. And they don't necessarily want to make the move because we've been anticipating rate cuts for so long and it still hasn't come to fruition. What is it going to take to convince people to actually make that move? Even a 25 basis point cut may not be the catalyst.
Yeah, I mean, so we've certainly been trying to convince people. You know, obviously a 5% overnight rate is a higher kind of level of rate than what you see with a 10-year bond yield or what have you, but you're not going to get that 5% overnight rate forever, right? As the Federal Reserve starts dropping interest rates, the yield that you're getting will also drop quite quickly. So, investors need to take that into consideration. I think the other thing that people need to remember as well is that, again, I said around a range of scenarios, the bond market does well. If you are in cash, that kind of money market type of investment, is not necessarily going to give you as good of a hedge against, a recessionary scenario or a scenario where the economy deteriorates more than expected. And you're not going to get those hedging benefits. So, moving out into like the intermediate part of the interest rate curve is where we like to be. We think it's a sweet spot. We see a lot of value there, and it gives you these nice hedging properties as well.
Tiffany, always appreciate your joining us. Tiffany Wilding is economist at Pimco, the bond shop, joining us from California. Thank you so much. There is some breaking news here that has nothing to do with chip companies or tech companies. It's Big Lots, old school retailer, the off-price home goods retailer, is contemplating a potential bankruptcy filing after years of sales declines. This is according to people familiar with the matter. Romaine, we also know Big Lots is potentially seeking investors in order to avoid Chapter 11 as well.
Yeah, I mean, this is a company that's been on the road. I was just taking a look at it. I mean, we're talking about a stock that's basically down 99% from its all-time high. That was really just about 3 years ago.
It's trading below $1.
And this was a stock that was $72 a share, and now basically closing out the day around 73 cents. And you see the drop down there. I mean, it gets to the point here of like, how does a discount? I mean, we talk so much about how Costco's doing well, Walmart's doing well. Why is this discount retailer somehow was not able to get out of its own way and make money like the way the others did?
Maybe it doesn't have the right suppliers. It's not getting the right goods and inventory to be able to attract the consumer.
Those shares down about 33% here in the after hours trade. Of course, Nvidia also oscillating between gains and losses, still soft. We're going to set you up here for some of the big market moving events over the next 24 hours. When we come back, this is The Close on Bloomberg.
All right, investors continuing to try to make sense of Nvidia's after-hours trading following its latest earnings report. The stock currently down about 4%. They'll be hanging on to every word of CEO and co-founder Jensen Huang this evening when he speaks exclusively with Bloomberg Television. So joining us now with more on that conversation is Bloomberg Technology co-host Ed Ludlow. Ed, congratulations on getting the interview. What will you be What's first on your mind when you speak with Jensen Huang when it comes to this outlook, which failed to meet the highest expectation?
Yeah, it's never enough, is it? I think Blackwell. So Nvidia has this commitment to bring a new generation of AI accelerator to market every year, annually. And they told us two things. One, they did make a design change which impacted their initial production, which will ramp starting in the fiscal fourth quarter of and then ramp into fiscal year 26. This is the fiscal year 25 they just reported. And they said that in that fiscal fourth quarter, there will be several $1 billion of sales of this cutting edge chip. But it's not enough. What does several $1 billion mean? Give us a dollar figure. Who's buying it? Who will get it first? At what scale will they adopt it? All these kinds of things is what the market's crying out for.
Give us a sense here, Ed. I know they don't talk a lot in the release and in the presentation about competition, and I know that competition is still relatively nascent. But I do want to hear, if I can just give you a question to ask Jensen for me. I am curious as to whether it's at least on his radar, if he's watching AMD, watching TSM, watching some of these other companies and what they're trying to build. And is he worried at all, or should he be?
Well, when last I checked, I think AMD is the most significant decliner after hours in terms of the peers. I think it was down 1%. You made a really interesting observation earlier, which is that basically Nvidia just has 5 customers, right? The hyperscalers and Meta. Those hyperscalers are working on their own silicon, but they also do benchmark and have specific use cases for other AI accelerators. For example, AMD would very proudly boast other of those names using its AI accelerator. The issue is just the scale. Nvidia will do $100 billion of sales this year. AMD will do $4.5 billion. They just haven't been able to catch up in deploying that technology into the real world.
All right. Well, of course, this is still obviously the most consequential stock and really the most consequential story for the broader market, maybe even for the economy. economy that we've had in quite some time. And Ed Ludlow is going to have a chance to sit down with the man at the center of all that. Nvidia CEO Jensen Huang going to be joining Bloomberg a little bit later today. Special coverage starts at 6:30 p.m. New York time with Ed Ludlow. Be sure to tune in for that. Meanwhile, there are some other potentially market-moving things out there, if you care about them. And it starts tomorrow morning with more earnings, not quite as consequential as Nvidia, but maybe some insight into the economy.
Yeah, and insight into the consumer as well, right? Dollar General, Best Buy, American Eagle, Burlington Stores. So it kind of runs the gamut in terms of product and price point. And then aftermarket, a turnaround story, which is still in turnaround mode, which is Gap.
Yeah, that's still early turnaround mode there, but yeah, good for them. Interesting to see. I am curious to see what Ulta Beauty has to say. There's been some concerns here that beauty isn't quite holding up as much as people thought.
Warren Buffett's not concerned.
We also get Marvell Technology as well, so another read on what's been going on in the tech space. Also tomorrow we're going to get, well, those GDP revisions for the most recent quarter, weekless jobless claims, and here you go, Scarlett. We haven't heard from him in a while. Fed speak from Raphael Bostic.
Didn't we just hear from him today?
I think so.
Yeah.
You're going to hear from him again tomorrow, and of course we will have full coverage of all of that. We want you to stick around here on Bloomberg. A lot is coming up tonight. Of course, Balance of Power coming up at the top of the hour, and at 6:30 p.m. tonight, we'll sit down with Jensen Huang, the CEO of Nvidia. This is Bloomberg.